There's a big problem in India. Every video or podcast we listen to is telling us how great India was. I'm not denying any of that. Everything great about India is absolutely correct. Of course, it's fascinating to know about our past. But the problem is, no one is talking about the current state or facts about how India is progressing in today's world. Everybody is only praising the past. What about the present and the future? So today, I'm going to break down a report that tells us everything about how India is performing in today's world compared to other countries globally. We can also understand through data what we need to focus on to become the best India possible. This is a very interesting report released by Blume Ventures, where they conduct research and gather insights about the evolving India, putting it all together in what they call the Indus Valley Report. India's business and startup scene has transformed so quickly in the past 4 to 5 years. Significant changes mainly occurred in the last 2 years. During this time, we have seen many startups succeed, but we have also seen many fail. If you talk to anybody in India about starting your own business, you'll generally receive two kinds of feedback. One, an optimistic answer where you will hear why your idea will succeed. And two, a pessimistic answer where you will hear why your idea will definitely fail. And this tweet by Didi depicts exactly that. India's growth story is precarious. Both the optimist and pessimist are disappointed. Before we dive into this report, I'd like to give the due credits to the authors of this report: Sajid Pai, Nachamai Savitri and Anurag Pagaria. In the first segment of this report, we compare India's performance to countries like the United States and China. India has been a key driver of the globe's economic engine today. India's gross domestic product or GDP stands at $3.7 trillion. The journey has been filled with ups and downs. And as we can see from this graph, COVID-19 was particularly hard hit to its GDP growth. However, India's predicted GDP growth of 6% for the fiscal year 2024 is impressive, outperforming many other countries including China, the United States, Indonesia and even the global average. Despite discussions about India's growth rate and its place among the top 5 global economies, we need to look deeper. For this, we need a better metric term than GDP. By dividing the total value produced by the country, that is GDP, by the population of the country, we can see that India has a long way to go. It has indeed progressed and grown as a country, but when you consider the economic output per person or GDP per capita, our growth isn't as impressive. Comparing the largest economies by GDP, China has about the same population as India, but economy 5 times larger. When you compare per capita GDP, India ranks much lower on the list, even falling behind Bangladesh. If we compare just India and China, we see different drivers of GDP growth. India's growth is primarily driven by private consumption, while China's growth is fueled by significant investment in GFCF, which is their investment in machinery, infrastructure such as roads, railroads, bridges and plants. But why does India underinvest in gross fixed capital formation or GFCF? In the past, many Indian corporations borrowed heavily to invest in infrastructure, hoping for a long-term return. However, 3 key factors have led to a decrease in such borrowings. Firstly, between 2015 and 2018, there was a crisis for non-performing assets, where many companies were unable to repay their loans. Secondly, the uncertainties brought about by the COVID-19 pandemic discouraged companies from taking on more debt. Lastly, the low use of these investments, such as factories and buildings, couldn't justify the expense. You see, the government treads where the private sector doesn't. As corporates retreated, the government stepped in, increasing capital expenditure from about $2 trillion in 2015 to $10 trillion now. This is an effort to improve India's infrastructure, similar to China's approach. To be able to pull this off, the government needs more funds. And where does the government get money from? Taxes. But the challenge lies in the fact that not many people in India pay taxes. India's tax to GDP ratio hasn't changed in the last 7 years. This means that India collects less tax than other similar countries. While corporate tax, which is collected from companies as a percentage of GDP, hasn't increased much, the income tax, which is collected from individuals, has risen from 2.4% in 2020 to 3% in 2023. However, the number of people who pay income tax in India is surprisingly low. Out of country's 1.4 billion people, only around 74.4 million or 5% file tax. Moreover, only 1.5% of Indians, approximately 29 people, pay income tax. Compared to other countries, this number is low. In China, 10% of people pay income tax, while in the United States, the number is 43%. Interestingly, only a small portion of Indians contribute to most of the tax collected. Just 0.3% of population contribute to 80% of the tax collected, showing a significant imbalance in tax contribution. Due to low tax collection, the government heavily relies on borrowings or loans. From 2012 to 2023, our public debt rose from $587 billion to a staggering $1,385 billion. India's government debt as a percentage of GDP is at the higher end globally. However, gross fixed capital formation is only a part of the bigger picture. The other part is consumption. India underconsumes on several categories thanks to a smaller than presumed spending class. Blume calls this class India 1. Essential items like food make up most of India's consumption. The percentage of income spent on non-essential items has increased from 13% in 2000 to 21% in 2022. An interesting fact is that 75% of India's retail market is made up of groceries, compared to just 40% in China and 30% in US. With such high spend on necessities, India underconsumes on several other categories. A deeper look reveals that China has significantly more domestic air passengers, with 590 million compared to India's 152 million. When examining the elevator density, India only has 0.5 elevators per 1,000 people, while Switzerland boasts 32 elevators per 1,000 people. In terms of dietary habits, China's per capita protein consumption per day is 108 grams, whereas in India, it's only 66 grams. Well, of course, India having a lot of vegetarians, this number is lower. Looking at the ownership rates, only 8% of Indians own a car, 24% own an AC or a cooler, and 38% own a refrigerator. However, at least half of the Indian population owns two-wheelers. India's vast population has a remarkably small consumer class. Despite its size, only a specific segment of population contributes the most to consumer spending. According to Goldman Sachs, nearly 1.2 billion people in India live on an annual income of less than $5,000. Only 112 million people have an income between $5,000 to $10,000, and 60 million people have an income about $10,000. In order to have discretionary spending, which is money spent on non-essential items like entertainment or luxury goods, you first need to earn a substantial income. However, there's only a small portion of the population in the country that earns enough to have significant discretionary spending. The report categorized the Indian consumer market into three main groups. The first group, referred to as India 1, consists of approximately 30 million households with an annual income of around 12 lakhs. This group is the primary target of most startups, as they have significant disposable income. The second group, India 2, includes 70 million households or 300 million people with per capita income of about 2.4 lakhs. This group is emerging as heavy consumers, but they are hesitant in spending. But they tend to spend more on media, gaming and edtech, and even engage in online gambling due to the convenience of UPI and autopay. They have started buying low-cost items online. However, the third group, India 3, is the group that doesn't have the kind of income to be able to spend anything on discretionary goods. This group includes about 205 million households or a billion people, earning roughly 80,000 rupees per person. They don't have the income to spend on non-essential goods. Most startups agree that this group is not their target audience if they want to be profitable and achieve large-scale success. India 1, India 2 and India 3 is a powerful organizing framework to understand India, pioneered by Kishore Biyani. This is what he said on Nikhil Kamat's WTF podcast recently.
So my theory, which I wrote it also a long time back in my book, is I call that India is divided into three parts. Three India, consumption के हिसाब से India 1, India 2, India 3. India 1 is the consuming class. Anybody who has a domestic help for me is a consuming class. Because consuming matlab not basic consumption but some value added consumption. India 2 is the serving class, which makes our lives better. The drivers, the helpers, the peon, the watchman, the liftman. And for every one India 1, there is 3 to 3.5 India 2. And unfortunately, India 1 doesn't give enough money to India 2 to make them consume discretionary products. And then there is India 3, which is farm laborers. They live on aids and factory workers.
The outer limit of the consuming class seems to be 30 million households across several premium consumption categories. We see a range of 25 to 40 million unique users or 20 to 30 million households. Here are some key facts to highlight. In 2022, only 1% of India's population traveled abroad for tourism. There are 30 million homes with wired broadband and 40 million unique credit card users. Only 22 million people pay taxes and 40 million invest in mutual funds. There are around 25 to 30 million households that own a car. Less than 30 million people have a demat account with more than 10,000 rupees. So roughly, there are about 25 to 30 million households in India that are technologically savvy and have the ability to make online purchases. India's consumer class has expanded from 2011 to 2023. With income about 8 lakh per annum increasing from 20 million to 80 million people. In 1995, only 0.5% of Indian households were part of the consumer class, but by 2021, this rose to 8%. Over the past 4-5 years, this consumer class has been consuming more, with mobile postpaid and credit card users nearly doubling. This growing consumer class shows a preference for premium products, leading to faster growth rates for brands like Zara and Nestle compared to D-Mart and Unilever. As a result, sales of entry-level vehicles are decreasing while SUV sales are increasing. Similarly, the average selling price of property is rising. Interestingly, Apple sales in India have surpassed the sales of Hindustan Unilever, which is one of the largest FMCG company of India, indicating a growing appetite for premium goods in India. Investors in public market are now focusing on companies that target India's wealthier class, as they believe these companies have the potential for faster growth. The equity market in India is a space where people speculate on prices and supply-demand trends rather than producing tangible goods. Systematic investment plans or SIPs have been a significant factor in driving activity in this market. SIP allows individuals to invest a fixed amount regularly in selected stocks. With smartphone apps, it's now much easier to buy small quantities of various stocks every month, leading to an increased domestic investment in the market. As a result, mutual funds are reaching record high in the country. In 2014, only 4 million people were actively trading, but by 2023, this number had grown to 25 million. The year 2023 also saw a significant number of initial public offerings or IPOs. Despite this growth, the Indian stock market size is still smaller than the market capitalization of tech giants like Microsoft and Apple. Reliance is India's largest company by market cap, valued at $250 billion. Interestingly, the most active investors in India's equity market are the affluent class, often referred to as India 1, who have excess disposable income and are increasingly investing in the stock market. One financial trend that has been gaining momentum but has its pros and cons involves personal loans. In particular, small and unsecured loans have seen a 12-fold increase in volume over the past 5 years. However, their actual value has only increased 3.5 times, indicating that majority of these loans are small. Many non-banking financial companies, including fintech startups, are granting these loans, often to people who don't qualify loans from traditional banks. This approach is risky, as it means these startups are lending to people who are less likely to repay the loans, a trend that's becoming increasingly evident. 2/5 of personal loans are given to borrowers who already have more than 5 loans. There's a threshold increase in loans granted to defaulters, who are less likely to repay. In fiscal year 2023, 23.1% of new loans were given to borrowers who had at least one late payment. This is double the rate from fiscal year 2019. As more loans are given to riskier borrowers, delinquency rates worsen. This is a problem for startups that need to show growth. They target riskier customers, which can lead to issues. Around 26.2% of loans under 50,000 rupees are not likely to be paid back. Interestingly, the lower the ticket size of the loan, the less likely for it to be paid back. The report suggests that we are reaching the limit of credit market, meaning we are nearing the maximum number of people who can be given loans and expected to pay them back. This issue will persist until disposable income rise. People who are new to credit are usually from the poorer half of the population. They are not familiar with how credit works and paying it back regularly. This leads to Reserve Bank of India's concern. Taking many loans from multiple lenders, creating repayment problems is a rising issue. The Reserve Bank of India is coming up with measures to make lending more difficult, but the problem persists. Let's move on to exports. India is the largest exporter of human capital. We have the most significant number of its citizens living and working abroad, a trend that leads to high levels of remittances sent back home. This has resulted in a steady increase in the money flowing into India from abroad. In the United States, Indians are the second largest group of immigrants, and a significant portion of professionals in the fields of engineering and science are of Indian origin. Furthermore, the Indian community in the US is the highest earning ethnic group. However, not all Indian immigrants send money back home. For instance, in Canada, the Indian community contributes less to remittances than expected given its size. The export of services, especially in software, from India has been consistently increasing. This is because many US companies invest money into Indian IT services companies for cost-effective solutions. The software or IT sector in India has created 4 million direct jobs and 12 million indirect jobs, making up to 30% of India's professional sector. From 2005 to 2023, the global market share of Indian IT firms has increased significantly. A noteworthy comparison is that while Saudi Arabia's oil exports are $223 billion, India's IT exports are $194 billion. This shows that while Saudi Arabia relies on oil, India relies on its engineers. India's growth story continued till 2023. But a slowdown is now apparent due to advancements in AI and reduced global spending on new technology development. Instead of creating new softwares like video conferencing platforms, companies are opting to use existing solutions like Zoom. This means US firms are less likely to hire Indian companies to build a software from scratch. Instead, they are asking them to integrate existing APIs like Zoom into their products. This leads to smaller teams being hired to accomplish the same task. The Indian government is now focusing on exporting its digital infrastructure like UPI. India is also gaining global recognition through its achievements in sports and the widespread adoption of its digital payment system UPI. Now, let's shift back our focus to the government. Technology is a big part of how the government operates in India. Almost all Indians, about 90%, have Aadhaar, which is a digital identity. Additionally, there are 500 million Indians who have Jan Dhan accounts, which help include more people in the financial system. When we talk about the digital public infrastructure or DPI of India, we think about the key elements like Aadhaar for identity, UPI for payments, and DigiLocker for data exchange. These services allow for online, paperless, cashless, and secure access to a wide range of public and private services while protecting people's privacy. The direct benefit transfer system makes it easy for the government to reach every citizen in the country. Over the last decade, India has built one of the world's largest welfare programs using this digital infrastructure. Through this approach, the government has been able to transfer about $350 billion directly to beneficiaries. As of March 2022, this has led to a total saving of $33 billion, is equivalent to 1.14% of the GDP. Startups have also taken advantage of this digital infrastructure to innovate and provide services more efficiently. Grow and Zerodha have benefited greatly from Aadhaar, while Paytm and PhonePe have utilized UPI to their advantage. Cred and Zerodha have leveraged DigiLocker effectively, and ONDC serves as the backbone of Nammayatri. If we take Nammayatri as an example, which is a ride-sharing services in Bengaluru, we can see that driver earnings increased from $0.5 million in November 2022 to nearly $6.4 million in January 2024, with 3 million completed trips in January 2024. If we focus on ONDC, it consists of three main parts: mobility, e-commerce, and credit. Mobility, as seen with Nammayatri, is showing positive results. E-commerce is still in its early stages, with usage not as high as expected. Credit services are yet in development. Additionally, the government has introduced various schemes to support these startups. such as Samridh scheme, the Atal Innovation Mission, the Seed Fund scheme, Startup India Aspire, CGTMSE, Pradhan Mantri Mudra Yojana, and the Multiplier Grant scheme. Reforms in the space sector have also been implemented, allowing non-government entities like startups to conduct space activities through InSpace, a single window clearance agency under ISRO. Now let's look into the startup ecosystem. In 2021, there was a frenzy of investment, with founders raising substantial sum of money. This was driven by intense competition for capital, leading to hasty decision making. However, the haste came with costly lessons. Both the number and total value of deals have dropped by over 60%. Late stage funding has particularly suffered as IPOs haven't met expectations. These developments underscore some key points of the market. The startup seed market is active but moving slowly. Unlike in previous years, first-time founders are receiving less attention from seed investors. Investors used to take chance on fresh, young founders with bold ideas, but now they prefer those with some prior experience. Seed investors are now leaning towards founders who have already launched their companies successfully. However, there are emerging micro VCs that are focusing on supporting first-time founders. In the venture capital space, making unique bets is crucial because once a bet is obvious, it becomes too expensive and competitive. Some investors are now backing founders at that idea stage before others catch on. In 2021, there was a lot of FOMO, which means fear of missing out. People were anxious about investing because they didn't want to miss out on a good deal or they were unsure if a deal was trendy enough. Founders believe that it's essential to raise a lot of money from India and be highly visible, even if you don't need the funds. This is because many funds from outside India look at the market and invest in top 1 or 2 players only. By showing that you're a big player, you attract more investment. However, this trend has likely faded away because there's less FOMO now, and people are taking their time with investments. Nowadays, most unicorns have shifted their mindset. Instead of focusing solely on growing and spending without limits, they are now realizing the importance and understanding of their business and profit margins. In 2021, many late-stage investors were holding back and not investing as much as before. It will be interesting to see what happens with them in the coming years. As the number of unicorns decrease, more companies are opting for IPOs to raise funds to provide liquidity to founders and early investors. While some IPOs have been successful, others haven't done well. Additionally, there's a rise in SME IPOs, especially for startups facing challenges in attracting growth investors. These startups may choose profitability over rapid growth. For instance, Zomato has seen a plateau in its monthly transacting users in recent years. Let's talk about a new trend that's becoming really popular in India over the last few years: digitally native brands. Traditionally, retail worked by making a product, striking deals with storefronts, and advertising through billboards and TV. But now, many brands are starting online. These are founded by people who deeply understand a specific problem, like targeting kids or focusing on men's wellness. They start small, raising a few $1 million and packing their products nicely. They use influencer marketing and sell on platforms like Amazon. Once they gain traction online, they move into physical stores. Building a brand is crucial in this game, and I believe creators will disrupt this space. With an existing audience, they won't need to focus as much on brand building activities. We'll likely see more creator-driven brands emerging in the next few years, shaking the industry. From 2018 to 2022, digitally native brands went from 25% to nearly 40% of the online market. Many of these brands were previously unknown, while some were old companies rebranding themselves. IPOs like Mamaearth's have inspired others to follow suit. The funding market is strong because investors understand the playbook and potential profits. They guide founders step by step in making easier to replicate success across different industries. There are 4 reasons why this market works well in India. Firstly, many family offices are investing because even though the revenue isn't huge for venture capitalists, it's enough for them. Secondly, founders are more traditional, focusing on margin unit economics, profit and loss sheets rather than new technology. They believe in building strong brands rather than unique products. Thirdly, there are great enablers like ship rocket that help with logistics and shipping, making it easier to build online brands. Lastly, Shark Tank has been a game changer, boosting brand value and attracting more customers. Remember Skippy Ice Pops? Their revenue skyrocketed after appearing on Shark Tank. As product creation becomes easier, the real challenges lies in brand building. Eventually, there might be companies offering end-to-end solutions for product, allowing business to focus solely on building their brand identity. Many traditional brands are rebranding themselves to appear modern. Marico, for instance, has Cocosol, Pure Sense and Fitify. Similarly, Reliance has Avasa, Netplay, DNMX and Team Spirit. These brands aim to detach themselves from the parent companies, presenting themselves as unique and trendy. They operate independently with separate teams, packaging and offices to create an illusion of distinct entities. The strategy is to keep their ownership discreet and not reveal their connection to the parent brand. One interesting observation is that quick commerce has become quite beneficial for many of these brands. Nowadays, people are very impatient and don't want to wait for their packages to arrive in 1 or 2 days. They prefer their packages to be delivered within the next 30 minutes, and this is mostly fulfilled through e-commerce companies like Zepto, Instamart or Blinkit. Currently, Blinkit is now leading the race. India has now become the largest market for smartwatches based on the number of units sold. Moreover, Boat has risen to become the world's second largest brand for wearables in terms of shipment volume, surpassing brands like Samsung. Additionally, we are witnessing a surge in smart appliances for home. Brands like Atomberg are introducing smart fans, and there's a lot of innovation happening in cooking appliances as well. With the advancements of AI, we can expect fantastic technology that's not only smart but also personalized. These appliances will be able to perform tasks without much manual intervention and will understand your preferences and needs. Lastly, many of these brands born in the digital space are expanding globally. For instance, the companies like The Minimalist are selling the clinical skincare products through Sephora in the UK and are now eyeing expansion in Vietnam, Singapore and Australia. Similarly, Lenskart has already extended its operations to the UAE and Singapore. Another noteworthy point from the report is about India's hallmark space missions. These missions have been carried out with budget of less than $100 million. To put this into perspective, the cost of a Boeing 737 MAX, a commercial plane, is $138 million. This showcases India's frugal yet ambitious approach towards space exploration, aiming to achieve remarkable feats with significantly lower budgets. If you enjoyed watching this entire report breakdown with me, ensure to give me a like. Definitely comment what your thoughts on where India will stand by the end of this decade. But please don't make this a political debate. And please subscribe for more such amazing content in the future.